Welcome to this launch event of a new CEPR report on Ukraine. This is Jan Kranen and Alexander Wodniansky. We are both sitting here in Frankfurt at the offices of Research Center SAFE. And so we are the only persons in the room who are in one room, while everybody else is single, but almost all the authors of this report are present today and will speak at one or the other moment of this launch event. Before saying more words on the way we organize this webinar, I want to hand over to the president of CEPR, Beatriz Veda de Mauro, to say some opening remarks for this event. Beatriz, please.
Thank you, Jan. Thank you for giving me this opportunity to welcome everybody online and to also thank everybody who has contributed to another very important hallmark on our attempt to help Ukraine think about, and Ukrainian citizens and policymakers around the world help think about the intellectual and analytical foundations of rebuilding and reconstructing. This is by now a real series of reports, the very first one under the leadership of Yuri, who is also, of course, very key in all of the ongoing reports. He has been leading the Ukraine initiative for CEPR, and going back to the very first one, which a group of us got together and very quickly in March, in fact, just after the invasion, came up with a series of principles that would somehow pin down what needed to be thought about in terms of a Marshall Plan for Ukraine. At the time, that seemed like something completely illusionary. How could you think about rebuilding and reconstruction in a war that had just started? We are now years on and we are still in the war, but it has become absolutely evident that not only thinking, but already starting on rebuilding, modernizing, reconstructing Ukraine is absolutely key. With Yuri at the helm, we have in the meantime issued a second report about more details of such a Marshall Plan. There have been two reports on the macroeconomic framework for Ukraine during and after the war. And now this one here, which highlights the necessity of thinking also about the future financial system. We all know the financial system is key in allocating resources and reallocating resources. This is going to be a large challenge, and already is a large challenge for Ukraine. And it needs, again, to be tackled. It needs to be started now. In many ways, things have already started. And as I was mentioning, what were the odds 2 years ago that, or let me say 3 years ago, if you had been asked what are the odds that Ukraine would get would be on the fast track to EU accession, that Ukraine would have a IMF program in the middle of a war-torn country, that the US and Europe would constantly and with large effort, but successfully be able to support Ukrainian people and its government in defending against what seemed at the time a absolutely bad odds. And yet here we are, and ready to start thinking about more detail of what needs to be done. I am going to close this introduction by again thanking everybody who made this effort, and by wishing us all very good luck in continuing and actually starting to implement the reconstruction of Ukraine. And this is now, I would like now to hand over to the authors and the panelists. Thank you, Jan.
Yeah, thank you, Beatrice. So I take over for a very short introduction. And in the spirit of what Beatrice said, I wanted to go back to the initial days, I would say, of our study, which really started at a workshop organized by the Research Policy Network, which is also CEPR run, on European financial architecture. We were discussing basically issues relating to Ukraine, and there were big sums of money in the room that are needed or are estimated as being needed to do a meaningful reconstruction process. And that was early in the war when we started it in 22. And that these numbers, if anything, have grown since then because the damages have grown. What I was and what we were discussing in this workshop was that there are a lot of estimates about sums of money, but there was not much talk about how to ensure that these large amounts of money will do really what they are supposed to do. So who really speaks about the nitty-gritty details of an allocation system that brings the money to the best project, that identifies the best projects, that monitors these projects, that makes every effort to make this reconstruction funding a successful endeavor. So how is this being done? And of course, our RPN on European financial architecture has exactly this type of topic, thinking about the financial system as an institution building exercise and something that can be done poorly or it can be done well. And there are, of course, I would say it's almost like an engineering exercise, engineering thinking about financial system building. And we thought, why don't we put all our quote unquote wisdom and experiences together in an author team to try to define what we think is the required and needed to make Ukraine's financial architecture a role model, if you wish, for countries that face big problems, damages, and have to be rebuilding their infrastructure, rebuilding their economy. And the financial system is, as Beatrice said already, probably instrumental in achieving this. You can have a poor financial system and you pour in a lot of money with not much success, not much impact. But with a good financial system, you may actually be able to attract investors from around the world to put their money into the future of that economy. And this is really what stands behind our effort. Can we formulate requirements, ideas, suggestions for rebuilding what is already there? As Beatrice said, a lot has been done, but it's already there, making it better, such that investors who are far away from Ukraine, who don't know the details of anything going on in the country, can nevertheless entrust their money to this economy, to this country, via the existing financial system. So can the financial system help to establish trust in the capital markets in the end? So that has been our major, our basic idea. For this purpose, we got together as an author group. I don't speak about the composition, but we are a mixed bag of people with Ukrainian background or who are working in Ukraine today and from all over the world, actually. And it was really a very great experience. The only difficulty was finding a time slot for meetings where everybody could be available, given time zone differences. Today's webinar has two purposes. The one purpose is to give the audience, I would say, a taste of our report. So we will have brief presentations of 3 parts of our book. Basically, we cut our book in 3 parts, so 3 sessions, and we will have brief introductions, like 10 minutes. This is very short and should just mention the most important ideas that we present in these parts of the book. The second purpose is that we invited other institutions that will be responsible for all the progress that can be made in the future, that work on implementing a structural change and have to subscribe to it or alter it, but who are important institutions whose comments we have been asking for. And these institutions is from the European Commission, the Director General on Neighborhood and Enlargement. It is the National Bank of Ukraine. It's the European Bank for Reconstruction and Development. It's the Federal Ministry of Finance in Berlin. It's also a research institute, the Economic Research Institute in Kiev, and it is a financial market participant from an asset management and investment banking group also in Kiev. So we have both participants from Ukraine and from Europe. We have from academia, we have from financial markets, and then from some major policy institutions. I will present the names of the speakers later when they do their comments. We will also have Q&A sessions at the end of every session and at the end. In the end of each session, it will be very brief, just for getting more clarification. It's mostly for among the speakers to add interesting ideas or questions. At the end, it's the Q&A with the entire audience, and I want to ask everybody to put up their questions in the Q&A button at the bottom of your screen, write it in, and you can also look at the questions of others and vote them up if you find they are very important. But we will live on these questions later on. Finally, I want to thank Martin Sandbu from Financial Times, who will start the Q&A sessions whenever they arise. So that's so much that said. I think I hand over to Yuri Gortnichenko, who is one of our authors, and who will give us the introduction into the first part of the book. Yuri, please.
Thank you very much. Let me share my slides. And I also want to say a few thanks in the beginning. First, I want to thank Beatrice for supporting this initiative and being a true leader in supporting Ukraine. Very, 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 very grateful to you. I also want to thank my co-authors, Elena, Harold, Jan, Vlad, Alexander, and Ilona for being such a wonderful team. It's a true honor and pleasure to work with you. I also want to thank other people who contributed to this report, but who could not put their names on this report. So I want to recognize their important contributions as well. As Jan said, we're going to split this comprehensive report into three parts. One is going to be about the financial history of Ukraine, so to say. One is going to be lessons from the Marshall Plan, and a few brief words about the governance of reconstruction and reform. And I hope we'll have more time towards the end of this webinar to have Q&A and cover more ground in these areas. Now, in terms of financial history of Ukraine, we'll probably need many, many hours to cover this, but let me focus on this one figure, which shows the time series of market capitalization in Ukraine over time. And what you should see here is, several stages. The first stage or phase was the economic recovery in the late 1990s and early 2000s, when the Ukrainian economy was booming. And we'll also see a massive development in the financial sector, and specifically the stock market had a fantastic run. Then we have the global financial crisis, which affected Ukraine very, very negatively. The stock market basically collapsed. And then we had a period of stagnation here, plus, all sorts of, Russian aggression rounds, right? So we have the annexation of Crimea, we had the occupation of the Donbass. Now we have a full-scale invasion, and so the stock market is in deep freeze. So to some extent, this is idiosyncratic to Ukraine, but some lessons are very common, not just for Ukraine, but more broadly for Eastern Europe. And I think it's useful for us to kind of look back at this history and say, how does the history of Ukraine compare to the experience of other Eastern European countries, and maybe this is going to inform us about challenges that Ukraine is going to face in years to come. Let me start with two countries which also had problems with Russia in the sense that Russia occupies parts of these countries, Moldova and Georgia. And you see that, the financial markets never really developed in these places, just because the policy uncertainty, the security uncertainty is so strong that these countries are hardly investable. And this is kind of one thing we want to avoid in Ukraine. We want to have ironclad security. It's also instructive to compare Ukraine to Bulgaria and Romania, two countries that are now members of the European Union. But these countries, initially at least, had all sorts of problems with the reforms agenda, with corruption and so on. And this, delayed development, financial development of these two countries is telling us that there is a significant cost of not having an ambitious reforms agenda, that you can continue to be a laggard for years to come. You can also look at other countries in the region, Croatia, Hungary, Czechia, and so on. And what you should see here is that this boom in the early 2000s, this was not unique to Ukraine. All Eastern European countries enjoyed this era of easy, cheap money. They all had an economic boom. Then you have a collapse everywhere in the stock market in the region. But then we see there is a lot of heterogeneity in how fast we have recovery across all these countries. For example, you look at Croatia, this is the light green, or you look at Hungary, these countries never really recovered after the global financial crisis. On the other hand, you look at Poland, right? So this is Poland, and you see that the recovery was much more robust. And this is telling us something about how aggressive we should be in resolving the legacy of crisis. For example, here we have an era of non-performing loans and all sorts of problems in the banking sector. And some countries were very aggressive in trying to resolve this as quickly as possible. Some countries were kind of more delayed in how they respond to this crisis. And so the result is financial development and lending specifically were much, much more suppressed. And this was a factor that delayed the development of these countries. So to make this, long story short, what I want to say about the financial history of Ukraine is that there are many forces that are common to all Eastern European countries, like, oligarchs, poor property rights, all sorts of things. But, some things are going to be specific to Ukraine. And, in particular, this is going to be the security situation and all sorts of meddling from Russia. Now, the next thing I want to, before I move on, what is the envelope of what Ukraine can achieve within this continental financial model? And that's going to be basically given by what we see in Germany. This is this black line. And you can see Ukraine has a lot of work to do, a lot of ground to cover. But we see that some Eastern European countries are kind of moving in this direction. And so there is hope that Ukraine can approach this frontier as well. Now, the Marshall Plan. Okay, so this is the gold standard in the literature, and I guess in thinking more generally about how countries can recover, what is a successful program. We see that the Marshall Plan involved a lot of money. The distribution of resources was uneven. We have lots of success stories. So it's not just a single country that benefited from this program. But one lesson we have from the Marshall Plan is that people tend to focus on this as basically a demand stimulus. You have this ruined economy, you spend a lot of money, and then suddenly through this demand driven policies, you can have a massive recovery very quickly. We know this is not just demand stimulus. There was many more elements that made this program a success. For example, you have to have presence on the ground to make sure you understand the situation in specific locations, and you can be effective and directing resources to where the returns are going to be the highest. And so in particular, this meant that the program was tailored to specific countries to address their specific bottlenecks in the development. It was also about the types of funding that was provided to support the recovery. For example, the Marshall Plan was mostly based on grants to make sure that countries are not going to be saddled with debt for years to come. They also want to make sure that the local governments are going to have skin in the game, so they have to contribute some resources to the reconstruction process. And perhaps most importantly, it was not just about rebuilding an autarky in Germany or France or Italy or anything like this. The main idea was that we want to integrate Europe. We want to create linkages. And for example, the multilateral European payment system was one of the critical elements that made this all work. Now, obviously, this has immediate implications for how we should be thinking about the reconstruction in Ukraine, what kind of funds we want to have, ideally grants. We also want to have some type of debt relief so that Ukraine can start from sort of a blank check if you want. We also have to be thinking about where we have these bottlenecks, critical infrastructure, power generation, transportation, this kind of things that are going to be critical for enabling other sectors. We also want to have a clearer sense of ownership. If we rebuild a bridge, a road, a school in Bucha, we're doing this because the local community needs it, because they want it, not because some foreign charity or whatever wants to put a flag on these places and say, well, we rebuilt a bridge here or school or something like this. And finally, it's all about integrating Ukraine into the global economy, and specifically in the European economy, because ultimately this is what is going to make recovery a success story. We want to make Ukraine a part of global value chains, and to this end, it's going to be extremely important that Ukraine is going to be a part of the global or at least European financial ecosystem, because once you have access to much deeper capital markets, your ability to grow fast is increased significantly. Now, my last chapter is going to be the governance of the reconstruction process. And the main challenge here is really that you have to juggle so many balls. So, all the circles here, this is not incidental. This is all the balls we have to juggle. We have to be thinking about bringing the economy fast into some type of recovery. We want to make sure that businesses are going to resume. We have to be thinking about upgrading productive capacity in the economy. We have to be thinking about European accession. We have to be thinking about democratization. We have to be thinking about structural reforms and attracting people back to Ukraine. Part of this is going to obviously rely on foundations such as macroeconomic stabilization. We don't want to have a boom-bust dynamic where people are very happy with early stages of recovery and then they face a massive crisis and they get disillusioned. We don't want that. And most importantly, I want to make sure that this is all built on ironclad security. I already mentioned this. We just want to make sure that another Russian invasion is not possible for foreseeable future, because otherwise Ukraine is not going to be an investable country. Now, fortunately for us, we have lots and lots of funding sources available for recovery, multilateral, international, and so on. Yeah. Here we have some innovation, institutional innovations that we propose. Jan, I hope we'll cover more of this at a later part of this webinar. Let me stop here and thank you again.
So thank you so much, Yuri. It's an absolutely wonderful presentation. I'm very, very honored to be associated with this report. It's, I think, appearing at a very, very important time because with the uncertainty about the outcome of the war, it's even more important to sketch out how the future looks after an end of the conflict and after the aggression is stopped and reversed. So there are two commentators in this session, as in the other session. The first discussant is from the European Union, Marlene Rosemary Madsen, who's the Deputy Director of the Ukraine Service and has been critically involved in much of the discussion about the European engagement in Ukraine and the framework which Europe will lay out, has laid out already, but will develop even further for Ukraine's integration in a European economy. Marlene, please, let me hand it over to you.
Don't hear you at the moment. No, we don't hear you, or I don't hear. Nobody does. Marlene, we don't hear you yet.
Can you hear me now?
Yes, yes, thank you.
Thank you very much. I've been running around from one application to another today. Apologies for this. No, thank you very much for this introduction and for the invitation to be on this panel. I think it's a very important topic indeed, and also very much appreciate the work that you have been doing on this, setting out in your report this multi-layered challenge of the governance of the Ukraine's reconstruction process, and also with the very important focus on the importance of the financial sector and the financial markets in the economic recovery and reconstruction. In the report, chapter 3, you rightly outlined the magnitude of the institutional challenges in the reconstruction and recovery efforts that are very specific to the Ukrainian context. I also just want to say, indeed, we have been working very closely with the Ukrainian authorities, in particularly these last 9 months, on building the framework for the reconstruction. Hopefully, quick for the short to medium term, the main structural element for this, and something we've always been really quite impressed by is the robustness of the financial sector in Ukraine during these last 2 years, and of the responses from the National Bank of Ukraine in addressing many of the issues. But that being said, of course, there are also many important steps ahead. In the so as mentioned in the report, chapter 3, what we see is indeed a very adequate of your report, of the outline of these institutional challenges going ahead. What we also what I wanted to also just quickly say is that reconstruction has already started. I think that's important to also bear in mind. Across Ukraine, the citizens and companies supported by public institutions are doing their utmost to repair, recover, and modernize already now. So it's not like we are waiting for the war to end. The work has already started. There are also importantly 3 phases to the recovery as we see it. So there's the macro financial stabilization, the support to keep the state afloat and the economy functioning. There is the public sector-led reforms and reconstruction of public infrastructure, but there is also importantly the private sector-led reconstruction and investments in new capacities. These phases will overlap, and we want to make sure that the EU is addressing, our support is addressing all 3 elements in the Ukraine facility that is the main vehicle for supporting Ukraine from the EU side. So the approach, as I said, in this Ukraine facility mimics these 3 areas. So we have a very big pillar on budget support to address the needs of the first phase, and that is also bringing about a lot of very important reforms that can help also the financial sector and the reconstruction phase. We also have in the Ukraine facility an investment arm where we have something called the Ukraine Investment Framework, where we are trying to address public and private investments. And at the same time, we're also continuing to provide technical assistance to support the reforms and to support the enlargement path. So what was mentioned earlier on is the importance of also, one thing is the financial stability, the financial market, but also thinking in the global value chains, but not least very much also the European value chains, and so something that is built in the reforms that are part of this Ukraine plan that the government submitted to us on the 18th, or the government adopted on the 18th and submitted to us on the 20th of March, and where the Commission has positively assessed this. Your report here is also rightly pointing out 2 key aspects in all phases of the reconstruction. Firstly, the linking reconstruction to key reforms and the accession path, and also bringing in the architecture for the reconstruction. And this is exactly what has been seen in the Ukraine plan that I just mentioned, and we are very happy to see and fully support, and will make sure that we also continue to support over the next 4 years. It is very important to have this stable recovery and investment architecture, but also have the prioritized and sequence reforms that can support in general the economy and the recovery and reconstruction. On the financial sector reforms, if I just may, a few extra words. I think after we also have to make sure that the financial sector, as I mentioned, has been really, really strong, very much helped by the efforts by the National Bank of Ukraine, actions to curb the external pressures and maintain stability of the exchange rate, and supported by hard-won structural reforms before the war. But the financial sector has remained stable, and we have not seen, for instance, a run on the banks as could have expected to a country in the situation that Ukraine faces and has faced for the last 2 years in particular. So that is really absolutely crucial, and something that we need to continue to support. The financial sector reforms and alignment with EU acquis in this area is a key part also of both the accession agenda, but certainly also this Ukraine plan. The Ukraine plan identified the financial sector as a major growth stability factor, and then also, as I said, to ensure that the correct identification. So there are 4 key reforms and 6 implementation steps in there. But maybe I should just stop here, and if there are questions in the round, I can go into the depth. But it's just to say that the banking sector and the state-owned banks is a crucial part, and addressing the non-performing loans, of course, as well. But I will stop here. I know I've already spoken a lot, and give the word to the next speaker on the panel.
Well, thank you so much, Malin. It's a great privilege now to invite Sergei Nikolaichuk and to go to, I believe, to Kiev. Sergei is the Deputy Governor of the National Bank of Ukraine. And thank you, Sergei, for being here.
Thank you, and thank you very much for the invitation. It's my great pleasure to participate in the event together with such distinguished speakers and share the thoughts on such important topic as the financial architecture and the financial sector role for the economic recovery. So first, I would like to highlight that Ukraine's financial sector did suffer losses stemming from the war, yet it is far from laying in ruins, and I completely share Marlene's words about the robustness of our financial and especially the banking sector. The reforms of the sector since 2014, as well as NBU's decisive actions since February 2022, prepared and supported the system. Of course, NPLs did shoot up in 2022-23 from 27% before the invasion to more than 39% in mid-2023, but this indicator has been on a downward trend, and these NPLs are well provisioned. So banking sector remains well capitalized, while banks repaid refinancing loans earlier and paid significant tax revenues to the budget. Also, banks provided around 180 billion hryvnias of net financing to the budget last year, and continue to do that this year. And despite that, the banks have cautiously been increasing lending since mid-2022 as the demand for loans from the private sector started to revive. So at least the banking sector is well positioned for the wartime and post-war recovery from our point of view. But of course, the needs for the the needs of private sector for effective recovery are massive, and further development of the financial system is indeed crucial and among our priorities. So actually, many of the points and initiatives highlighted by authors already included in the strategy of Ukrainian financial sector development, updated by the NBU and other regulators last year. For instance, EU accession and financial euro integration is a common thread through the strategy. Moreover, many of authors' proposals are already part of our strategic documents being developed within the cooperation with the partners. For example, according to the MFP with the IMF, Ukrainian authorities committed to include the vision for the state-owned banks and financial institutions in the update of financial sector strategy. That should also reflect the preliminary vision of the financial infrastructure for economic recovery. Update of state-owned bank strategy is important task both within the MFP with the IMF and also Ukraine plan with the EU. Lending resumption strategy to encourage sustainable and productive lending so is our task to be developed, to be finalized by the end of May, according to the MFP. Other key elements of financial infrastructure, such as the framework for war risk insurance, are at the final stages of discussion by policymakers. Also, authors propose to establish the National Reconstruction and Reform Council as the visionary body to form high-level reconstructions and reform policy and monitor its implementation, backed by the political and social consensus. Frankly speaking, the Euro, we already have a similar body, the National Council for Recovery of Ukraine from the Consequences of the War under the President. So it was created almost exactly 2 years ago. Formally, it has an advisory role, but the functions suggest a visionary calling of this body. And it includes all the top elected and appointed officials. From our point of view, it's worth to reconcile these two councils, one existing and one proposed, as well as second layer of the NRC and technical level of the Ukraine donor platform. That are not trivial tasks for sure. Also, authors strongly advocate for establishing a separate Ukraine development bank. We call for caution on this issue. The main question from our point of view should be the following. What is the value added of such entity in Ukraine's context? Multilateral development banks like EBRD, the EIB, and IFC have a long-established relationship with Ukrainian domestic and foreign-owned banks that have passed their strict integrity checks and, as I said, well capitalized. Besides, we have to do our best to make them closer to the most EU requirements, which will lower compliance costs. These multinational development banks have to date implemented numerous projects in Ukraine and so do not require a special structure to enable them, albeit, as authors point out, mostly with large blue-chip state and private companies. Moreover, the government already has an entity with potential to become a source of co-financing with existing reliable banks, the Business Development Fund, and of course, improvement of its governance and processes is already a requirement from the IMF. BDF could be transformed into the version of the development bank or the fund, as I personally prefer to call it. Sure, such approach should include the involvement of international development banks with on corporate governance and funding, in corporate governance and funding areas with strong Ukrainian ownership through the governmental coordination. And finally, it is crucially important to find the optimal balance between state and quasi-state support, including via the international development banks, and accelerated transition to the market-based financial sector, especially during the war and at early stages of post-war recovery. The authors propose their broad helicopter view on some specific issues. However, devil is in details, and we all have to work hard to find the optimal solution for such uneasy tasks. Thank you again for such initiative and raising these important issues and the chance to discuss them.
Thank you so much, Sergey. That was wonderful. We're almost out of time, but just before we transition to the specific reform agenda for Ukraine's banking sector, I think we have time for at least one question. And I see Martin Zanpu on the Financial Times' go-to person on everything European. Martin is there, and you have a question, I believe.
Hi, thanks very much for having me. Good to see everyone. Can you hear me well?
Yes.
Look, I know we're close to out of time for this panel, so let me just raise two difficulties, and then people can choose how to respond, or you, Hal, can choose what to do with it. I mean, I like a lot of what's in here. I think the discussants show that there are different views on many of the specifics. I want to just raise two difficulties on the sort of overarching bit, which is what this panel has in part been about, before we get to the specifics on banking and capital markets. And both of them are a version of how we're kind of trying to target a moving target. We're trying to hit a moving target here. So two examples. So one is the report says everybody wants market-based financial system, market-based allocation of capital, but we also want to address bottlenecks. But addressing bottlenecks, that's really planning. So there's a trade-off here, or a choice to be made that I don't think comes out very clearly between how much market and how much basically state-directed planning. Bottlenecks are very lucrative in terms of private returns, but social returns are very high if you remove bottlenecks. I've detected in Ukraine quite a wide range of views in terms of what sort of economic system we want to get to, more US-style market-based, more European, German or French state-directed. That's a choice that needs to be made, and it's harder because even in the international expert consensus, the correct role of state direction in financial markets is evolving very fast. So that's difficulty number one. Difficulty number two, we of course want to converge on EU standards, but EU standards are themselves changing. And in the matter of financial regulation specifically, we know, and the EU itself recognizes, that there's far from enough harmonization. So banking union is not complete. Capital markets union is even less complete. We have far too little cross-border flows of bank lending and equity capital. If the EU does what it's promised to do, it will upgrade its banking and capital markets systems. But that means that Ukraine now has to think not just about how to, check all the boxes in the current acquis. I think it needs to think a lot more strategically about, where is the EU likely to be 5 or 10 years from now in terms of financial market design? And what is it that Ukraine has to do today to put itself in the best possible position with that market 10 years down the line? So I'm saying these are difficulties. I don't have the answers to these, but I think these are questions that haven't been, appreciated sufficiently.
Well, thanks, Martin. I think the first one has really deep resonances with the story of the Marshall Plan, in the sense that one of the key bottlenecks for Europe in the late 1940s was the energy sector, and the energy sector is exactly what is really been under attack. And over the last weeks, it's been increasingly targeted by the Russian aggression. So, thinking of this as a bottleneck that needs to be removed before anybody can do anything else, without the power, you really can't do anything. And that is a classic task, I think, for coordinated action. And in that sense, I don't think of that as in any way going back to central planning. It's removing a really crucial bottleneck. I don't know whether Yuri wants to comment on the second aspect of Martin's question.
It is indeed a very difficult question, and that's why we want to have a council and a platform to think about these issues, to aggregate ideas, preferences, and come up with one unified policy on this. Also, we'll talk more about the development bank later, but I just want to make clear that this is a tier 2 institution. This is not going to be a bank that is going to loan money directly to corporate customers. And there is always some value in having something national because priorities for BRD, EIB, or World Bank can be evolving over time. And so we can't always count on them in current conditions because they can say, we have too much exposure to Ukraine and so on. I'll stop here in the interest of time, and we'll talk more about this at the Q&A. Thank you.
Well, thanks again, everyone. And it's a great pleasure now to hand over to Elena for the second part of the session, the reform agenda for Ukraine's banking sector. Thanks, everyone.
Thank you, Harold, and good afternoon also from my side. I think it's a perfect time for transition to the banking sector side, given also the second question that Martin posed. So the presenter is going to be Jan. And so yeah. I don't know, Jan, if you have slides or not slides, but the floor is yours.
No, I have no slides. Maybe I put up one slide when we talk about the institution, the one that Uwe couldn't put up in his one because I cut him short. In this second part, we want to talk about banking and banking structure, so to speak. And since the limit is 10 minutes, I have to be very condensed. I will speak about two aspects of our reform proposal. The first one relates to the existing banking system and its structure. How can you improve the reliability and the preparedness of that banking system to channel money into good projects in the future? So that's my first part. And the second part is about that institution that has been named several times now already, but not yet described in detail, the Ukraine Development Bank that we are proposing. I go back to the first part, basically the reform agenda for Ukraine's banking sector. The basic idea is to make this banking system more trustworthy in the eyes of international investors whose money is expected to be needed to cover all the projects, to fund all the projects that people are speaking of when they talk about the reconstruction of Ukraine. So how can you basically leverage the existing financial system so it can channel and use more funds than it does today? And if you look at today's banks, you find a number of problems that make the loanable funds and the banking sector rather small. Some were already mentioned. We have a very high ratio of non-performing loans, which means basically loans that block the money available, the capital in the bank for further lending, whether they are provisioned or not. So that's one thing. Secondly, a very large fraction of the banking sector is really investing in government bonds, which is good for government because it gets the savings that this bank can generate, but it's not good for the corporate sector and for the whole reconstruction issue, where you want the banks to use their expertise about the economy, about the corporate sector, to channel the monies into good projects. That's currently happening only to a rather small degree. And of course, the question is, how can one improve this? We make a series of proposals how to do this, starting with an asset quality review of the banks to determine whether or not there is any shortfall in capitalization of the banks. If there are shortfalls, then to refill it using government money from some source, we speak about that later, but that there is some recapitalization of the banking sector through which the institution that carries out the recapitalization will basically get stakes in all these big banks. Now I speak about the biggest bank of Ukraine, 4 or 5, all state-owned, that will, after that process, be partly co-owned, so to speak, by this recapitalization agency. And that agency will have the role to privatize these banks, or by selling their holdings over time in a certain limit, like in a 10-year period, in a sophisticated way, thinking deeply about creating a good, I would say, quote unquote, and stable ownership community that will care for the future of the bank and their business model. So that's basically step one. Step two would be to increase the loanable funds that banks can use by taking out the government bonds or part of them and transforming them into cash, basically taking over the government bonds, giving them the banking system the money back so they can invest it in lending, in the reconstruction of the corporate sector mostly. And lastly, to have a better supervisory architecture that is capable of conveying trust to international investors. And we think that one way of basically enhancing the supervisory quality would be to get more closely aligned with what's being done everywhere else in Europe when the orientation, the standards, the practices come from the SSM at the ECB. So basically having something like a memorandum of understanding that will help the supervisor to follow rules which can be seen transparently internationally. That's our first package, so to speak, that's making fit the banks in the system. Package number two is building a new institution, the Ukraine Development Bank, which has a new function. The function of the Ukraine Development Bank is to connect the Ukraine's financial system, banking system, to international capital markets, to raise funds and then channel it onwards to other banks, not to do projects by themselves, except for large infrastructure projects, maybe for the government, but anything else would be refinancing the banking system with money raised internationally. For this raising exercise, the institution needs capacity, trust, equity, all these issues that make it valuable to have a new institution. So in that sense, I would, I think, enter into a longer discussion with Sergej, who said we don't need a new institution. I think a new institution, that was also after our discussions in the group, is something that would enhance the capacity to connect the existing financial system to international investors. To do that individually is very difficult because building trust through operations and governance system is a fixed cost that otherwise would have to be incurred many times in Ukraine rather than just one time for such a development bank. And the development bank would be a tier 2 institution, and as a tier 2 institution, it would only be used and would only basically deliver funds to the tier 1 banks which are already existing and which have been transformed in our package 1 into viable and sustainable financial institutions. Okay, so these are the main point. The aspect that we also mention is that this transformation process in the banking sector may have to be handled by some institution, and that could be the early years of this new development bank. There could be like an investment bank for the other existing banks in the country, doing their privatization process and recapitalization exercise. And lastly, the UDB, the Ukraine Development Bank, will have to have a particular, I would say, governance structure, which I think can be aligned with Sergej's comment on the multilateral institution that exists. So these multilateral institutions should be co-owning that institution, which is majority owned, of course, by Ukraine. And then you have this joint endeavor, which is not globally active, but focused on the Ukrainian side by interacting with the existing banking sector. It's a joint from Ukraine to the rest of the world that this financial institution, this new financial institution, could provide. I will leave it at that.
Thank you very much, Jan. Also perfect timing. So let me move now to the first discussant. We don't have the second one connected yet, unless I miss to see her. So maybe, Alexander, for the moment, you can take a few minutes more if you wish. So Alexander Piva-Borawski is the Director of Capital and Financial Markets Development at the BRD London. So your institution has been called already several times so far at the moment, and you have massively contributed also to the work on Ukraine. So thank you for being with us today, and please, the floor is yours.
Yeah, thank you very much, Elena. Can you hear me? Is it reasonably good?
Perfectly, yes.
Yeah, thank you. So first of all, I wanted to congratulate everybody on this very interesting report. And it brings together a lot of very interesting ideas based on international experience. It was really a pleasure to read. I have a few comments on each of the parts. I think these are very rich chapters on the banking system and the one on the development bank. So there's probably, we can't cover it in a short conversation, but I will try to give a few, I hope, useful comments. So on the sustainability and the quality, let's say, of the banking system, there is some of the work that is mentioned in the report is actually already under preparation. So there's, and it's very good to see that the colleagues thinking about it are in a way aligned with what is being prepared. And I think in Sergei's comments, he also alluded to that. So asset quality review, so the central bank does regular stress testing and kind of analysis of banks, and something that was already done. And then NVU, of course, can speak better about this, but there is also preparation ongoing for a future asset quality review to be done at the right time soon, when there's a feeling that the security situation is more permanently stabilizing. The regulatory alignment work is also ongoing. So actually the authorities in the very first days of the war resolved that to accelerate through any channel regulatory efforts. And so actually regulatory alignment on the supervision is one of the priorities of the authorities. We're actually supporting it through a technical support project. And it is something that a number of neighborhood countries have done around the European Union, and it helps to unlock additional cross-border finance from the European Union and actually make, in a way, in our view, it strengthens commitment of the European banking groups in these countries, and it could be a step on the way to full alignment during integration EU accession process. The off-balance sheet bad bank. So there's a discussion in the chapter on this topic, and of course, I'm slightly biased on that because last year there was a first big report, and Ralph de Haas from EBRD and we provided a chapter that was very broad, covering many aspects that are in much more detail discussed in this report. And we, at that time, felt, having looked at different models, including in various countries where we operate and outside EBRD region, and we felt that for several reasons, shifting some of the bad debt or much of it actually, to a single institution could have benefits. And apart from the things mentioned in the report, there are kind of structural reasons for why it could be beneficial. First of all, some of this debt will be related to the war, and some of it actually still from the first war. And so it's in a way not the fault of the banks. So in a way that it should be handled in a maybe consistent fashion throughout. But also there are other reasons why. For example, in Ukraine, state banks are very careful about write-offs of debt, partly because of the governance challenges. So it's sort of whole separate area related to fear of being responsible for the loss of public funds. So because the state banks view bad loans as a kind of public funds out there. And so we helped actually the authorities over the last 5-6 years to improve the quality of this approach. There is a new system, so-called Kiev approach, mentioned in the last report, to help restructure and facilitate solution of this debt. But there was very little actual write-off, and some of these debt may need to be written off permanently. And so it is probably better to have this addressed by a specialized institution rather than having each individual bank deal with it. And some of these debts may stay forever on the books and slow down recovery of the financial sector. Then there is a topic related to the holding, which is, of course, also relates to the development bank. There are several comments there. One, there is a view that somehow investments into these existing banks, that they could be fully recovered. It's based on past experience, of course, not in such cases where we expect Ukraine to rebound and have a strong, recovery after the war, but is still in countries in our region's operation, there are unfortunately investors in the current environment. They sometimes require a reduction in book value, and if the government or the, let's say, or the holding decides that attracting a particular investor has its own value or merit, it may be necessary to sell some of these institutions below book value, partly because of it reflects the perception of quality, lack of transparency, and it may take a very long time otherwise to sell them. So something to keep in mind, that it's not always going to be a profitable business. There probably should be a way to privatize these institutions, and maybe to some extent even the holding, to list it at some point, because there are some good examples of that in our region. They need to engage state and IFI risk-sharing facilities, so to help deploy risk-sharing facilities, and these actually have proven to be quite successful even during the war. We in EBRD, we still offer risk-sharing facilities, some of them with European Union or other donor support, and actually it often is almost like the only game in town, and private sector, small companies have access to funds that they very much need. And on the removing public debt from the balance sheet, this is a very interesting idea. We don't have many examples to follow. Possibly this would need to be accompanied with some incentives, and also perhaps allowing households to purchase public debt directly. Because what happens now, and we see it, in the last year, let's say, where the deposit rates presumably have not gone up, and the banks have actually rebounded and made huge profits, partly because of the lending to the government. And so it may be necessary to think how the government would fund itself in an alternative fashion, and how you disincentivize banks from putting too much into the public debt. And then the topic of development bank. I think that it's actually a very thoughtful idea. A lot of thinking went into the governance challenges and the need to make it kind of truly international bank. But I will only highlight several things to think about in the process. Well, first of all, of course, is political appetite and political will. There are so many challenges around the war in Ukraine, and these will probably last. There is a need in championing this. For example, I was just looking up, preparing for this meeting. EBRD was established through the leadership of President Mitterrand, Margaret Thatcher, Helmut Kohl at that time, and so it's really important to have a political will, and of course to think carefully about how it would complement other institutions like EBRD, because we of course are very committed to Ukraine. We're being recapitalized to some extent, or mostly actually, to scale up operations in Ukraine after the war. So there will be a need to think about that, how to be truly additional. On the governance, it is really critical to ensure that it's politically insulated. In many of our countries, we see, and every now and then, quite frequently, the authorities come and say, can you help us set up a development bank? We think it will be unique and the best. And unfortunately, experience shows that it often gets politically captured. It's seen as a kind of a bank that the existing current party could control and could deploy, maybe could give jobs to the new party in power. So it's not something that needs to be really carefully thought through. Administrative complexity takes a long time to establish a quality bank. For example, AIIB, the latest arrival, and Eric Verglov is here on the call, maybe could say a couple of words, but it was a very big exercise to set it up, and it took It was first proposed in 2013, was established 2016, and its first loans were mostly parallel loans with other international financial institutions, and only eventually started doing, I guess, its own loans. And I would say it's similar to EBRD. In its early years, it took a little while to become really fully operational. And there is also a recent experience of EIB, which is thinking of or is setting up what they call a development institution, something to look at to see how that is going and whether there are lessons learned. So I would stop here. Oh yeah, maybe the very last thing is capital, human capital. Of course, it is important to make sure that if there's such institution established, that truly the best could be and politically unconnected people could be attracted to such an institution. We need to be prepared that the institution would compete for the talent from other existing development institutions. So maybe the experience of other FI suggests that having some work in parallel, using maybe secondees, etc., would really be necessary to carefully think through how to ensure that the quality of people is really excellent, but also that the other institutions are not decapitated as a result. So I'll stop here. Thank you.
Thank you very much, Alex. Let me ask first Martin if he has any question or remarks on this part, and then maybe given that we have a few minutes, maybe I read some questions. Please, Martin.
I do, but I see there are some excellent questions in the Q&A. So depending on how much time you have, I can wait and you can do them first, or it's up to you.
Why don't you start
All right.
With a couple of minutes, and then we can ask a question, then give back to Jan.
So I have two questions. The first is, I mean, from Jan's presentation, it sounds like you think that one of the big challenges here, apart from making the domestic banking system work, is that it needs basically help to get connected to the international banking system and the international financial system. But it seems to me that the experience from European integration in Eastern Europe, the current members, the 2004 cohort, I mean, that was not the issue. You had Western banks just coming in, snapping up franchises, and still running a lot of the banking systems in these countries. And so I just wonder, going back to what is the actual problem here? Why shouldn't we expect the same thing to happen in a large economy, hopefully at the end of a war with lots of prospects, well tied into European rules? Why wouldn't European EU banks simply come in, buy franchises, which is buy the equity of existing banks, or set up de novo and so on? I mean, isn't that the more likely outcome? In which case, what's the big problem that needs to be solved here? And that leads to the second question, which is about this Ukraine Development Bank idea. I mean, assuming that I'm wrong about this first thing and that there is a need to connect up, the way I understand it, but explain to me if I'm wrong, it's not really a development bank so much as a bank that finances development, but a financial intermediary that helps raise funds for domestic banks in the international markets. So an extra step. And so the question I have is, what is the advantage that this new institution would have that would allow it to raise funds internationally that the domestic banks don't already have? You were sort of hinting that there may be some informational problem that's solved because it's one institution, it would be better known and so on to skeptical foreign investors. But it seems hard for me to imagine an institution like that really having an advantage in the absence of an explicit or at least implicit public guarantee, in which case, is that really something we would want? Investors may go there because they think they'll be bailed out if all else goes wrong. There's also presumably a risk of adverse selection. No, the domestic banks that can go straight to international markets and get funding will do so, and this development bank will be left with the worst of the banks, and investors in it will see that and price their lending accordingly. So those are my questions, and it seems to me that some of the other questions are also on the development bank.
Yes, thank you, Martin. This was actually an excellent point. Let me indeed go to the Q&A box. So one participant expresses again the doubt on the need of having the development bank, but the other two instead ask a more precise question. One is still on this new bank, what capital would be needed for this bank to be established? So, because I think Jan also raised the point that this bank would need capital. And the second one is, instead, to attract private capital, what would be the most promising instrument? Covered bonds, securitization, others? Is the Ukraine market ready for this? Which maybe also help us transition already to the next session. But why, Jan, don't you take a few minutes to respond to these questions?
Yes, so thank you. These are, of course, the key questions that one has to deal with. I start with the question: what's the basic idea? Why is it needed to have a bank? What role does it play? Isn't there an adverse selection issue, so that basically banks that have a proper quality will access international markets directly? So I see the development bank's role in a steady state situation. So letting aside the starting period after the war, as being able to run particular programs. It doesn't hinder private banks that are successful to get access to international funding, not at all. But it is a possibility to carry out particular initiatives or programs that maybe the government wants to undertake. For instance, think of the energy transition, or think of projects that target particular small and medium-sized industries, so things that have not immediately access to international money. You can basically use this development bank to foster these type of activities, and the funding of that development bank can be either domestically or internationally. The way it is implemented is that this development doesn't do the project, this type of targeted lending by itself. So it doesn't really get in contact with the ultimate clients. It only co-lends with the existing financial system, so in the existing banking system. In that sense, it leverages the banking system's capacity to do these type of projects by offering additional funding and offering some risk sharing, not complete risk sharing to avoid this moral hazard issue, which is apparent here. But in that sense, it is a partner of the banks with a particular task that it wants to reach, a particular type of project it wants to do. And that gives the country an opportunity to do particular activities that by themselves wouldn't be undertaken in that dimension. And so that is, I think, a role that this development bank can play. And its access to international markets, of course, has a lot to do with a certain government guarantee that institution has, and that could, a bit like what we have seen in other countries, been started or triggered by the let's say, the grant money that is available in the early stages of the reconstruction of Ukraine's economy. There will be grant money. Rather than spending it directly on project, you can spend it, you can invest it in this type of tier 2 banking institution, which can turn the money over and basically leverage its net worth that it's basically is receiving. Why don't private banks come in and take over the Ukraine banking system? Well, that's a question that I may ask those that have looked at the earlier phases of Ukraine's development. There are foreign banks in Ukraine active, and but they are up to today have only a rather small market share. So it's not that they are ready and there to take over the larger banks. If this would be the outcome of the privatization process, I don't think that there would be much of an opposition, right? So that could be one outcome, but it's not clear whether that can actually happen. Does it then replace the need for a development bank? I think this is not the case, because the story that I told before in the steady state type of doing projects that are basically driven by policy decisions that remains as before, and activities that are taken over by banks that have been privatized, are taken over by foreign banks, would simply not show up on their balance sheet. So that would make this development bank in a way smaller. Whether that happens, we have to see. There is a lot of trust problem here from international investors' side.
Okay, Jan, I think it's the time to move to the next session, and we can retake some of these points in the final discussion. Let me just say that there is one final point that maybe we can also take up also for Ilona now that I give the floor to her, which is connecting instead the sovereign sub-investment grade rating. One participant is asking what will happen in particular if there is a likelihood that will remain the case for quite some time, if we can discuss it at some point during the webinar. But with this, thank you to Alexander again for the excellent discussion and Martin for the comments. And let me give the floor to Ilona for the third session.
Hello, thanks everyone for showing up to this presentation and for actively participation in the discussion. I would like now to invite Alexander Rudnyansky, professor of the University of Cambridge and a member of Supervisory Board for Ukrainian State Savings Bank and advisor to the President of Ukraine, to talk about capital markets and war insurance. Please, the floor is yours.
Yes, well, thank you very much for handing me the microphone, essentially, and it's a pleasure to be here. It's an honor to have worked on this together with our team, and hopefully this will be useful to Ukraine and its policymakers going forward in terms of implementation. I will provide a short summary of the final 3 chapters of the book or the report. The first one being on capital markets, and the last 2 on mortgages, or the mortgage market, which is important for Ukraine as for any other country in terms of its role, and war insurance, which is something that's more specific to Ukraine right now, but has also been seen somewhat around the world in crisis regions, if you look at Afghanistan or Africa, etc. So starting with capital markets. So we want to see thriving capital markets, and that is primarily equity or stock markets in Ukraine. And one way of going about it is essentially there's 2, well, first of all, before you get there, there's 2 corner solutions that you can have. Either you can go full in and say as a government, we want to create a stock market and somehow incentivize that to happen. That would be a very brute force interventionist approach, and some countries have done that. The other one is to say, look, we're going to outsource the whole market. So perhaps stock markets or equity markets are likely to be thin, not very deep if it's a small country. So why not just use existing markets in the region? So for Ukraine, Poland could be a relevant example, which has pretty well developed capital markets already. But there's also another approach, which is sort of a internal solution, if you want, sort of not a corner solution, interior solution, which is to rely on the organic development of stock markets and equity markets over time. And so that is what we advocate in the report. Stock markets, more generally, equity markets are important. So we should try and develop those and not just leave them to be outsourced on the one hand. On the other hand, plunging full in and saying, look, we want to incentivize and create our own equity market immediately by having a local index, etc., is also somewhat risky because that could just fail, essentially, with the alternatives around. And especially in the situation that we're currently in, that is unlikely to be a propitious idea. So what we suggest is to rely on organic growth. The downside of that is, of course, you're not going to see results in the short run, but you might and hopefully will see results over the medium to long run when the preconditions for the creation or the foundation of such equity markets become present. And so what are these preconditions? We go into some details discussing those. First and foremost, macroeconomic stability. That is a precondition for almost any economic success in any dimension that you think of. And the good news there is that this has actually already been, we could say is already there in Ukraine. It's been present since 2015, ever since the banking sector has been cleaned up. Inflation has been tamed. Even during the war, we've managed to hit our inflation target of 5%. Macro financial stability has been guaranteed. despite some of the problems in the banking sector that we alluded to before, banks are still solvent, they're well capitalized, and they're operational. So that is good news. The other key ingredients, of course, are things like institutional investors. We need institutional investors, in other words, to provide demand for equity. Now, that is something that's really still missing. We don't have pension funds, and that goes back to some of the pension reform ideas. Right now, Ukraine basically just has a pay-go system that is essentially funding pensions out of current taxes. There's very little in terms of a savings system, the second pillar of a pension system in most countries around. Basically, there's none. So that would be an important agenda going forward. Again, something that's not likely to be created within a short period of time, but is certainly necessary for pension funds to come around and to provide demand for equity. Another example is insurance companies. Insurance as a sector is also pretty nascent in terms of its development. It's a very small percentage of GDP, less than 1% of Ukraine's GDP is insurance, as compared, for example, with Germany, where I think it's 44%. There's other examples or other players that could be around, like a sovereign wealth fund and ideas that around that, where Ukraine could be using some of its commodity exports or natural resources going forward to create some of the profits of that could go towards the creation of a sovereign wealth fund. Again, there's pros and cons to that idea, but just another case of what an institutional investor might look like. So that's ingredient number 2. Ingredient number 3 is, of course, the legal system. Now, we will obviously defer to other discussions here, but everybody knows that Ukraine has some homework to do in terms of strengthening property rights, the efficiency of its judiciary, etc., minimizing and fighting corruption. So all of that is ongoing. Again, there's some radical ideas about how to proceed. Some have suggested that we should look at the example of Kazakhstan or the United Arab Emirates and create sort of a common law island or a legal system where for certain cases for companies could be referring to essentially English law and UK judges. That is somewhat of a radical idea, but again, one that's been floated. The other one is more gradual. Again, we should just work on improving the efficiency of our existing legal system, make sure we reform our courts, screen all judges and improve in terms of on their education, etc. And that's something that's certainly going on, and rely more on arbitration, perhaps. So that is another way to increase the efficiency of the current system and increase the amount of time that certain cases are demanding in terms of resolution. Now that's 3 ingredients I gave you. There's another one which is privatization more broadly. Now that is key in terms of actually creating the supply of equity, right? So Ukraine still has around 3,300 state-owned enterprises. That's way more, many magnitudes more than in any average or developed Western European economy. I think Germany has just a handful, like 10 or so. France has around 60. So there's a lot of potential there in terms of privatizing, and by the way, the financial system as well. Corporate governance, with that in mind, should also be improved. There's many success cases here already. And again, the banks are a prime example, but not just the banks. Naftogaz, for example, went from being hugely loss-making, around 6% of GDP were actually Naftogaz losses in 2014, to being profitable, etc. And I would say these 5 ingredients are key. But then there's also sort of second, not less important, but perhaps slightly less visible propositions, like the educational system, making sure that we work in financial literacy, ingraining financial literacy, or emphasizing more aspects related to financial literacy in the formal education system. Countries have experimented with that. Financial innovation, also, we would devote a section to that in terms of fintech. Ukraine has actually had some success stories in the fintech space as well, but I leave that to the readers. So these things could help advance and speed up the development of capital markets. So long story short, when we look at capital markets, we'd like to have them, but it will take time. And we suggest relying on an organic sort of evolutionary approach rather than anything radical. Now, let me just say a few words, because I think we're running out of time, about the final 2 chapters. Mortgage markets are obviously hugely important. And again, related to what was said before, we stress the foundations that need to be present for mortgage markets to develop in a healthy way, rather than just relying on state intervention here. So there's 2 forms of state intervention traditionally in Ukraine and other countries. One is providing essentially state housing, or where the state comes in and gives out housing or builds housing for people, and a lot of state programs. That's been around in Ukraine with its post-Soviet legacy, of course, but more recently, what's been very prominent is subsidized credit, subsidized mortgage loans. So essentially, all new mortgage loans right now during the war, more than 90% are essentially subsidized credit, hugely subsidized credit or mortgage loans. And again, there's pros and cons here, but clearly that's not a market mechanism, right? So this is something where the state has played a key role, and we can debate whether that's good or bad. Going forward, it can certainly have risks in terms of building up unhealthy credit, etc. So traditionally, there's been a lot of fraud in the construction and the mortgage market more broadly, and Ukraine has recently passed some legislation to address this. So money has been siphoned off on ongoing construction, and those construction firms then disappeared. So now there's a mechanism to go after these fraudulent schemes, etc. But fundamentally, again, somewhat like the previous chapter, the solutions here are more of a sort of long-term. We need to have a stable macro framework, in particular low inflation for rates to be manageable and not too high. Creditor rights need to be protected. And again, there's lots to be done here. And I will also stress one point which relates to transparency and anti-corruption. There's been endemic corruption in the construction market, and that's not a secret. So one of the solutions, there's many, but one solution is, of course, to, if you look at some municipalities, for example, to make sure that any municipal council member or local parliamentarian, in other words, who takes decisions that pertain to construction in the region should face a mandatory, comprehensive, high corruption risk declaration, income and asset declaration procedure, which is currently not the case. I mean, they have to declare their incomes and assets, but if they're taking decisions with regard to construction, they're not in the high risk category. So that's a bit of a specific piece of advice, but we also stress it. And finally, war insurance, just a few words. That is, of course, a very politically attractive idea right now. It's been flagged by our Ministry of Economy for more than 2 years, with unfortunately rather meager, if not pitiful results, unfortunately, so far. We don't have war insurance. The actuarially fair price of insurance will be prohibitively high. We all understand that. It's something that's relevant to the biggest firms, perhaps, not necessarily to the medium and small enterprises, but it's an instrument that probably will face some demand. So the ideas here, again, and they relate somewhat to the development of the insurance industry more broadly. So again, there's some legislation to be passed here. There's some work to be done on a national level, but there's also been suggestions that we should rely on some private-public partnerships with essentially our donors and international partners helping, providing a pool for some form of subsidized insurance, in other words, because otherwise it's just going to be prohibitively costly for anybody who wants to contemplate it. So there's been some ideas on how to do that, and we also have some examples in the report of what other countries did. So without any further ado, I think I will sum it up here.
Thank you, Alexander, for being perfectly on time. We now have 15 minutes and we have 2 discussants for this topic. And first I invite Markus Hoffmann from the German Ministry of Finance. Please comment on these issues.
Thank you, Ilona. Can you hear me well? Yes, I guess that's the case, if I don't hear anything. So thank you very much for the invitation. As you said, I take part in this conference for the Federal Ministry of Finance from Berlin in Germany. So you might be more used to speakers from other ministries within the German government, such as the Development Ministry or the Federal Foreign Office. But this subject that you are talking about today here relates very much to the areas of competence of the Ministry of Finance. So I'm very happy to be here. I'm the head of unit for a unit responsible for promotional banks such as KfW, EBRD, and CEB, and the unit is set up in the Financial Markets Division. So very happy to give my comments and remarks here to the report, and thank you already to Alexander for his very insightful presentation. So I consider the report as a very important impulse. It looks at the future financial architecture in Ukraine and how to enable the financial system to raise funds for reconstruction, and that obviously is a very important subject. a substantial number of the report's, let's say, baseline assumptions and views are very much shared. This concerns the obviously very large needs for funding for reconstruction and Ukraine, also the case for an important role of the private sector, as well as the need for strong Ukrainian ownership. I think the report is also very right that the lessons from post-war reconstruction in Germany and elsewhere in Europe show the importance of the institutional framework for reconstruction. So in my view, in particular, the report rightly underlines it's not important to ask only how much money is being spent, but in particular to decide on how funds will be spent. In that regard, the report, as outlined just now by Alexander, makes important recommendations for an organic growth of the capital markets, including on the trustworthiness and stability of the institutions and the quality of the banking sector. It also underlines transparent decision-making, good governance, and the essentiality of this for both international donors and also private investors. In this regard, also, obviously, the EU accession process will play an important role. So to be focused in the limited time, what I would like to do in the couple of minutes that I have left is give you some of my views with respect to the financial architecture in Ukraine, and also comment on some specific recommendations of the report, which I will also link to the work undertaken here in the ministry and also at KfW. All this, of course, is work in progress. Factually, we'll be returning also a bit to discussions on the Ukraine Development Bank, but I think that was an issue of interest to many of you. So happy to comment on that. So for the federal government, including, of course, the finance ministry, a coordinated approach for reconstruction support is very important. That's why bundling the financial support at the EU level through a Ukraine facility is a much welcomed approach. And also, as mentioned earlier by the Commission representative, there is Pillar 2 in the Ukraine facility, which is an explicit pillar aimed at mobilizing private investment. And also, of course, the Ukraine plan generally will make an important contribution to improve the business environment. As you also likely know, there is going to be the Ukraine Recovery Conference in Berlin in June, which will bring together different stakeholders, and private sector mobilization will be one of the four main thematic dimensions to be covered at the conference. So in this regard, I consider the report rightly stresses the need for a functioning financial market in Ukraine. This is also why our Minister Lindner, in a joint declaration of intent with his Ukrainian counterpart Marchenko, focused on capacity building in financial market supervision, money laundering prevention, and customs cooperation. This can pave the way for integration of European and Ukrainian financial markets. Moreover, I want to point your attention more specifically to a 15 points paper that the German government presented on April 10. And this paper also deals with the mobilization of private sector resources for reconstruction in Ukraine. It, in fact, is a first input to the Ukraine Recovery Conference, and it touches on several issues, including, for instance, the role of export credit agencies, but also the use of the limited budgetary funds to support private investments. Moreover, that paper actually also contains an aspect that is more closely related to the report we are discussing today, and that is the institutional strengthening of the development finance landscape in Ukraine. So concretely, the German Development and Finance Ministries are jointly with KfW and Ukrainian authorities working together to further improve the financial landscape in Ukraine. So specifically, the work we are conducting is setting up to develop the Business Development Fund into a fully fledged financial institution for small and medium-sized enterprises. So here again, we are fully back into the debate of what is the best structure, and I want to focus a bit more on the details of the report's recommendation. So first of all, I can underline the importance of a well-governed and institutionally sound promotional bank. We have very positive experience nationally with our KfW, and actually, as a side remark, being responsible for KfW here in the ministry, I was very happy to read some positive comments with regards to KfW. Secondly, I think an aspect that we didn't discuss at length so far is the idea of joint co-ownership of the possible new national promotional institution by not only Ukrainian authorities, but also by international partners and including MDBs. This might also actually be one element that could address the question that came from the audience on the possible rating of Ukraine influencing the scope that such a bank could have. So a third recommendation from the report relates to the creation of a new institution, and that instead of existing institutions, the main benefit of this presumably lies in strengthening the institution's credibility. At the same time, of course, it might be a different avenue of starting stepwise by using the existing structures in Ukraine. So another aspect in the report is one that also was not mentioned more deeply so far. Actually, the report proposes assigning quite a number of tasks to the National Promotional Institution. It would not only be a promotional institution, but it would also cover the task of recapitalizing banks and possibly taking government bonds from the balance sheets. That could be a quite challenging bundle of tasks. So happy to discuss these aspects in more depth. In any case, I've taken a lot from the report and will feed these aspects into the future work that we carry out here with our partners. Thank you for your attention.
Thank you. Now I invite Vitaly Vavrshuk, the head of the macroeconomic research department of the ICU group, to comment on capital markets and war insurance.
Thank you, Ilona. First of all, I would like to thank the organizers of this event and also the writers of the paper. I appreciate the insights that this report offers for the Ukrainian authorities, but also to a broader expert community. I agree with the conclusions of this report with regards to the Ukrainian capital market. I don't think that the local capital market will be a major driving force of Ukraine's reconstruction in the near term, but it definitely holds huge potential in the long run. There is no way to launch capital markets just overnight, right? This task requires huge investments of resources and time of dedicated professionals. Capital market in Ukraine will remain tiny in the coming years, even if most of technical and legal obstacles are removed. Total savings are very low, and the preparedness of individuals and institutions to invest for long term is also very low. To get an understanding of how much capital could be raised in Ukraine today, we can just look at how much Ukrainian individuals invested into government bonds. And the total investments now stand at about $1.5 billion. This is a very small amount. And so that means that individuals are broadly reluctant to invest. They clearly prefer to keep their savings at bank deposits or as cash. So it's clear that any large capital raisings are impossible if resources of foreign institutional investors are not attracted. Access of Ukrainian firms to foreign capital markets is just vital. And that means that probably having dual listings in Ukraine and abroad are the only way for Ukrainian issuers to be successful. Then, if the authorities want to relaunch the equity market in Ukraine, I think that probably the best way to start would be to IPO one of state-owned banks. So that would definitely attract attention and money of many retail and institutional investors. And it could become a flagship partial privatization case. And also an IPO of a state-owned bank would be would offer another significant advantage. So the bank's corporate governance standards would be under permanent scrutiny of hundreds of investors, and not only under the scrutiny of the government or the NBU. So that would provide more incentives for a bank to be more transparent and more efficient. Now I move on to the mortgage chapter of the report, which is my favorite. So if we needed to identify a financial market segment that offers the largest growth potential, I would say it is the mortgage segment. So the total stock of mortgages in Ukraine is less than 1% of GDP. Such a low ratio is just an anomaly by any standard. And that also means that the market may take off very quickly, but we need to have the right preconditions in place. Unlike capital markets, banking system already has a fully functioning lending infrastructure. Banks have capital and also liquidity to lend. And with such a low starting point, we don't really need complicated financial instruments like covered bonds or securitization to revive the mortgage market in Ukraine. Banks do have liquidity and they can increase their mortgage portfolio multiple times without facing any liquidity constraints. But of course, two things need to be done to make mortgage market more active. Firstly, we need to have lower interest rates, but we understand that this is something that is only possible if macroeconomic risks become lower. And secondly, we need a better protection of creditor rights. That is, basically, banks should be able to foreclose collateral within weeks. And my last portion of comments is about war insurance. Apparently, there are no ready solutions for insuring risks related to Russian hostilities in Ukraine. For Ukraine, a war is not a tail risk. This is a reality. This is an everyday problem. And I have to say that the domestic insurance sector is already adjusting to this reality, and it is already starting to offer war risk insurance for retail clients. And local insurance companies now sell policies that cover risk of damage of cars and residential buildings, even if risks are related to the war. So probably the quickest way to upscale offering of war insurance is just to leverage the expertise and potential of the existing market players, and then just start building new layers of protection or reinsurance on top of what is already available in the market. I like the idea of public-private structure at the top of the insurance scheme. This idea is mentioned in the paper. I think this is the right way to go. But I want to stress that at this point, time is of huge importance, and we definitely should move faster so that we could offer war insurance to Ukrainian individuals and businesses. Thank you.
Thank you, Vitaly. That are great comments. Please, Dr. Eric Berklov, do you have a comment? So please, the floor is yours.
Thank you, and thank you for a very interesting discussion. I particularly appreciate the comments from policymakers and experts in Ukraine. I think this is sets a tone of the discussion that I think is very constructive and maybe a little bit different from some of the previous conversations I've been part of. What I want to do, just offer very quick comments from a sort of international development perspective. So two things, and it really triggered by what Martin Sandbo was saying. I think there are two things that are going on right now in sort of the international development space. One is that there is a tremendous resurgence in the belief in the multilateral development banks, and that there are I've been active in these institutions for 20 years now, and so on and off, and I've never seen a period where there is so much belief in these institutions and so many possibilities to try to make them work as a system. And I think the suggestions in this report are very much tying into that discussion and that potential that this discussion internationally suggests. So this country platform, for example, that applied to Ukraine seems like a very promising way to think about how the international community can engage in Ukraine. The other thing that's going on also, which I think is equally important, is the kind of renaissance of development banks and thinking, as some other previous speakers were talking about, the transition that Ukraine needs to go through is not only about, of course, reconstruction. It's also about building an economy that is based on sustainable growth and very much part of the sort of global transition, energy transition, and maybe also a transition in sort of biodiversity, natural capital terms. In that context, these development banks and at the national level have proven to be very important, because there will be a need for subsidies or support or coordination, and this is where these development banks, of course, they need to be governed in a professional way, and that's where the participation of these international multilateral development banks can be very helpful. I personally think that one of the great possibilities for development, for international development, is to bring together these multilateral development banks and the national development banks, and again on these country platforms, and make that the way that the sort of system really works as a system. So I think, yes, going to give those general comments, because I think this report fits very nicely into that global development. Thank you.
Thank you. I now invite Martin Sandbu to open the Q&A session.
Thank you very much. That was fascinating. So I thought we could kind of do a sort of soft slide into general Q&A, and I could start with one question I had on capital markets. But Jan, we are doing this together. Should I kind of do the first 15 minutes? You do the second 15 minutes, something like that?
Yes, please. That's a good idea.
Let's do that. So I had a question, on this bit of it, and then I'd like to go to some of the questions that have come up on Q&A, some that were left unanswered from before, and one that's more recent. I mean, I really like the capital markets part of the report that we've just had presented. I mean, I like it so much, and I go back to the kind of teasing of the EU I started with this afternoon. I mean, do this and you'll be way better than most EU countries, right? So the EU, much of the EU isn't really a super satisfactory model. There's a lot to leapfrog here, and we know that the EU itself is in its better moments. Leaders are aware that capital markets are badly underdeveloped, and possibly the flip side is that the EU is overbanked. So I would just kind of encourage you to express even more ambition, as it were. But let me ask a little bit more concretely. Given the unfulfilled integration of European capital markets, integrating with Europe can mean very different things, and there are many different models out there. So in terms of countries, I'd like to hear a bit more specifically, both from the report authors, and if Alexander is able to share views from inside the Ukrainian government, that'd be interesting too. I mean, it seems to me that the countries you want to be looking at are something like Sweden, which is outside of the banking union and the euro, of course, but has a very good capital market, or possibly Ireland. Alexander, you mentioned Ireland in the context of common law, but there's obviously the mutual funds industry. What inspiration is there? I'll just mention as kind of keywords or bullet points, 3 areas of policy that I don't think you touched on, or at least not much, maybe I missed it, that seem to be very important in terms of growing a capital market. I'd like to hear what you think about them. So one is insolvency law, and that's one of the bits that are badly unharmonized across Europe. And the Letter report just the other week suggested a 28th kind of pan-European regime, how should Ukraine think about corporate law and insolvency law in terms of getting to the best point, also in the context of European development? Second point, I would guess that it's easier for a Ukrainian corporate to raise capital markets funds in euros or some other hard currency than in hryvnia. So how does this link to monetary policy, monetary reform, presumably in some future euroization? And finally, tax reform. Of course, this is kind of, economists love to point out that we're giving deductions for interest expenses and not for equity dividends in most countries' tax systems. I mean, is that at all the sort of thing that one could think about doing differently in Ukraine? So it's basically questions, are there ways to leapfrog here? I'll leave it at that, and then I will take some of the questions that have come up from the audience.
Yeah, well, thank you, Martin, for these great questions, and certainly that's some food for thought and great suggestions for us going forward. So regarding your 3 suggestions or 3 points on bankruptcy procedures and bankruptcy reform, I think we have a comment on it in passing, but certainly that's something that we should look into more detail. I mean, right now, and I think this is an issue in Europe more broadly, especially if you compare it to the United States. Once a firm becomes insolvent or bankrupt, in other words, it's hard to keep it operationally active, which is very different from Chapter 11 proceedings, for example, in the US. So that's certainly something that we discussed at a certain point, even before the full-scale invasion, I remember. But it never reached sort of the high priority list for the government for various reasons, I guess. And there's always putting out other fires. And currently during the war, of course, that's certainly not high on the priority list for unfortunately rather obvious reasons. But definitely something we should come back to. That's number one. And regarding your other points, absolutely. So I'm not sure there is much discussion of tax reform in that context. There's discussion of tax reform on and off, but in a very different context, sometimes in a rather unhelpful way, unfortunately, because people have ideas around tax reform that are much related to different issues, or much broader in terms of why they would like to see it or for whatever purposes. But you're absolutely right. This could be a way to leapfrog, as well as the other suggestion. But yeah, I mean, I'm happy to sort of go into more details here, or just maybe some of the other co-authors would like to chip in, maybe Yuri as well.
And maybe I make one remark on the insolvency law. So in fact, we are touching on that and basically emphasizing let's say, the introduction of strict recognition of creditor rights as a basic element to enhance to enhance credit in general and banking markets in general. So having that in a proper way, transparently, and in a way guaranteed that your rights are respected is one way also to incentivize workouts on the sides of firms that are in a weak position through their banks. So that's something that is an alternative to the Chapter 11 procedure. But there are basically 2 ways to organize restructurings and the dealing with weak companies. One is this US approach via the Chapter 11 thing, which means weak creditor rights and stronger shareholder rights. While the more, I think, common approach in Europe is to have it the other way around. In both instances, you see workouts going on. I think both systems can work, but they need to be consistently applied. I think that's the point that we are making in this report. Yuri has raised his hand. Maybe Yuri, you want to say something?
Yeah, I think people should just come in because it's a small group, and it's so just come in if you want to comment.
It's a great question if we have an overbanked economy or underbanked economy, at least in Ukraine. And I want to echo what Vitaly said earlier, that the capital markets are unlikely to be a major source of funding. We don't have a well-functioning private pension fund system. Insurance companies are too small. We don't have a sovereign wealth fund. And so realistically, in the short run, it's going to be banks that are going to be the main engine of financing in Ukraine. And I also want to mention what Marcus noted earlier, that KfW is a success story in Germany. We kind of want to learn from this experience, but obviously, if it's just exclusively a state-owned bank, it creates all sorts of problems in terms of incentives, political influence, and also the credit rating. That's going to be a big sort of counter argument why it should be a state-owned bank. But if you have a more dispersed structure where you have foreign investors, also members of this exercise, it's more likely to be successful in terms of resisting political influence, but also attracting capital cheaply. And one final point about the tax reforms, we touch on this very briefly in the report in the context of stimulating the stock market. We know some countries try to kind of ram through development of financial markets and offer very strong incentives. For example, if you list your company, you're going to have a tax break. And we think it's a bad policy because it doesn't create a level field. It's going to be used only by a handful of companies potentially. It creates distortions in other dimensions. And so maybe when we take a broader view of how the tax system should look like, it should be very simple administration, level playing field, very simple, very transparent, because the institutional capacity of the country to enforce tax laws is fairly limited, and we have to be aware of these constraints when we think about fiscal stimulus. Thank you.
Thanks very much. I mean, I'd like to bring up two questions that have been posed in the Q&A, over the evening, because I think they're important. I think I will ask them and then ask Jan to kind of take over after that, because I may have to leave a little bit before our final 7:15 end or 6:15 my time, if that's okay with you, Jan. The two questions are, I can't remember who asked this before because I've lost that bit of the thread, but it was about the sovereign rating being sub-investment, and I think let's just broaden it a little bit out to whoever want to answer. All of these well thought through plans, I just want to get your sense of how much they depend on ultimately being anchored to the sovereign finances and what that means for the realism of all of this. I mean, even we know that Eurozone countries, despite supposed banking union and definitely monetary union, the sovereign rating is still the foundation anchor of the financial system. So how do you think about that in the Ukrainian context and all these reforms that you have proposed? So that is one question. The other question is by Stefan Farr. He talks specifically about the real estate market, and the main bit of the question I think actually applies much more widely. So he asks, how can a policy ensure that real estate predominantly remains in Ukrainian hands and is not sold off to international investors in the early post-war? We could, of course, say the same about banks. We could say the same about corporates, and we know how this has caused political resentments in the 2004 accession countries. So how do we think about that, given that if all goes well, actually there'll be huge capital inflows into Ukraine, but that will bring foreign control and ownership with it. So that's kind of as much a political economy as a financial question. So those are the two questions I'd like to kind of put on the table. I'll leave to Jan to kind of handle the rest of that discussion, and thank everyone in advance for having me, and switch off my camera, but I will listen into the answers for as long as I can. Thank you very much.
Yeah, thank you, Martin, also from our side for your insightful accompanying our discussion over the full session. I think these were very valuable questions, and so we would live with them. Now I live with the two ones that you put up, and I look around for somebody who wants to say something on them. Otherwise, I will give it a try. So your first question that you left us with is on the role of sovereign rating. So are we in a way assuming that problem away in making our proposal. I'm basically saying, well, we assume that the sovereign will solve it through its immense credibility. And this is not very likely to exist, at least presently, and for a long time to come. So I see that, so my own take would be, to the extent that we depend on, let's say, sovereign rating being at least better than the average corporate rating in getting funds from international markets, our argument rests on support from other parties outside Ukraine. And these parties will not be willing, I guess, to come up with the funding itself and to cover anything near these enormous amounts of capital that have been mentioned in the estimates of the reconstruction. But they will come up with something. And the question is really how to use that something efficiently. And whether, if this is basically the basis for some, let's say, guarantee in a structured finance sense for some equity piece in investment project, I think that we haven't discussed that in the group, but my point would be that this is probably a way I would look at favorably and say this might be a good use of the money, and then letting basically the market play on the upper floor, where you have rather more senior instruments being traded, being handled, and that is where the market, also the international market, can work and can be liquid, but not on the equity side. So not on the high risk portion of the funding side. So in that respect, we are not relying on the Ukrainian government to get this sovereign rating that is required to do it all by themselves, and that is maybe the angle where the support would come in if we put the question that way. I look around to co-authors to make divergent statements. I think that's how I understood our position in this respect. And the second question, real estate, and let's say, can we really have a development that will not be sold off to foreigners, is something that I would answer this with, maybe we wished for that in a sense, or one could wish for that in a way, but of course not in a Wild West environment. So you would expect to have, and that is what all our proposals are about, to solidify the institutional framework, the legal framework, the rights of creditors, the rights of consumers, and so forth. So to make that's I mean, a lot of what we know about the effort to create an integrated market in Europe, not only for capital in capital market terms, but also in the banking sector, is to define solid, internationally recognized legal structures. And if they are in place, then maybe foreign ownership is not that much of a problem. I mean, we can say the same for other countries in Europe where foreign ownership is very high. And that need not necessarily be an issue, not even a political issue, but it is I would say, the result of let's say a majority of funding that comes from outside and sees this particular place as something that develops and that merits this investment. So I see the two sides, and there may be political opposition. I think that was what the question was intending to cover. And in that sense, we have to build a legal or let's say an accountable environment in which there is enough integrity in the system that people have not that much fear if ownership is not national.
Yeah, and if I can just chip in on this last point, certainly I don't think that the way to go is to have less economic freedom and to restrict foreign ownership in any way or form or fashion. In fact, that was always a stumbling block for Ukrainian development, and that it really formally or informally restricted foreign investment into various sectors. It was a big issue when land reform passed. Also discussions around, whether foreign political issue, whether foreign buyers would come in and essentially buy up all of Ukrainian land. Essentially, all of these stories then boil down to some myths or some scaremongering, and just trying to put the discussion of balance and somehow capture any reasonable proposals around the issue. So I would say yes, Ukraine has a higher sensitivity when it comes to these issues politically. It's always a question in any country whether more foreign ownership or less foreign ownership is something that is stressed politically. But in Ukraine, given its post-Soviet legacy, I think it's a huge issue, and the way to go is to make sure that we have less political sensitivity when it comes to that, not that we have less foreign investment. We'd like to have more foreign investment, just as Jan said. So I think that is really the issue, not so much that we should restrict or somehow look at investment that comes from abroad in some different way. We need to have a level playing field. We need to have strong institutions, creditor protection, property rights, etc. And then ultimately, there's always going to be a huge home bias, no matter what. It's not that the world is waiting to buy up Ukrainian land and property. It's really Ukrainians that will always present the lion's share of demand. So I don't think that is really the issue at all.
Yeah, and you want to have a stable financial architecture, so to speak, that is not pulling out when there is a critical time. Right? So I'm in a way reading off a remark of Eric Bergloff in the chat, right? That the experience with financial systems that have a majority or a strong role of foreign banks in their country is that if there is a crisis, these institutions will pull out. And to some extent, I think, but Alexander, you have to correct me, there was a stronger role of foreign banks in Ukraine some time ago, but they have in a way walked out because they can walk out so easy. Exactly. And in that sense, a certain home bias on the equity side of the financial architecture, I think, is important. I don't speak about the debt side. This is the senior tranche, so to speak, the senior part of fund. That can be international land that will flow, but the equity side will, in a way, deliver the basic backbone of stability and also of governance, which is at least as important.
Yeah, absolutely. I mean, Yuri showed that graph at the very beginning when we saw, the spike initially in the early 2000s of our stock market capitalization. During that time, there was a lot of foreign participation, a lot of foreign banks, like you said, in Ukraine. But these actors were actually burned in a bad way. They have still, bad memories of Ukraine. So if anything, we're going to have a challenge convincing some of these actors to come back and to signal to them that we do have better protection of property rights now, better creditor protection, level playing field, etc. And that we are really genuinely on our way towards European integration. So I think that is really the issue, not so much whether we should somehow avoid having these people in the first place. That would be counterproductive.
Yeah. If they would line up, one wouldn't say no.
Exactly. I mean, ultimately, at least that's my position. If you look at the most developed countries in the world, they are usually the most economically free, right? So, which means they have a very high share of foreign direct investment, etc.
Yeah. Right. But that's a situation where Ukraine wants to get.
Exactly.
Right. And so until we are there, we may need this sticks to get there. And I think that all the criticism that we have heard about this development bank is in a way well taken, but it is a long haul to get there, to have this system itself so trustworthy, so strong, not only from the financial side, also from its economic performance, that people basically deliberately put their institutional capital and so the equity capital, I mean, into Ukraine. And if we are there, then maybe development bank may not be necessary anymore. Then it boils down to executing more or less sensible government programs that are meant to solve some public good problem, for instance. And still then it may be needed for that purpose and not for the other purposes. But for the time being, I see this development bank institution as something that can generate this benefit all over the place. And not only for public good type of enterprise issues, but also for what I said, general SME lending, which hasn't been so strong recently.
Yeah, absolutely. And if I can just also chip in with one small comment with regard to the development bank, the Ukrainian Development Bank. I mean, that seems to be a very contentious issue, judging by the reactions and the comments that we get. Whether it's going to be implemented in this pure form or not, it remains to be seen. But ultimately, what we are trying to suggest in the proposal that we're making, and I just want to make sure this is very clear, we're not suggesting creating yet another state-owned bank in Ukraine. That's not the suggestion at all. In fact, we discussed this at length when we were writing the report. So I just want the audiences to hear that. What we are suggesting is having one institution that's similar to, let's say, the EBRD or some international organization that is then heavily involved and specialized in Ukraine. Whereas, because you will have, and you are seeing all sorts of demand and proposals spring up left and right about creating a fund, a direct investment fund in Ukraine, UDF, the Ukrainian Development Fund, other banks, other vehicles. The World Bank wanted to create its own vehicle. So instead of having various institutions springing up and then somehow not being coordinated, we're saying, look, let's just bundle the efforts internationally with these main actors and then go through essentially one institution, which we call the Ukrainian Development Bank. And that's it. So in other words, unless these other proposals are not helpful either, then it's either the case we're not discussing any proposals at all, and then the Ukrainian Development Bank doesn't seem to have a role either, or we bundle these efforts into one essential institution that would then benefit from economies of scope, etc. So it doesn't make sense to discuss whether the World Bank should set up a fund, whether some other private or maybe public-private partnerships should be setting up a bank or a fund, and then say our suggestion doesn't make sense. Either all of them don't make sense, or perhaps we should bundle these efforts and then leave the rest to the private sector. So nobody's saying that the private sector should be put away with, or that the government should expand its role. So I just wanted to make that very clear.
Yeah, we can just add on this. It's not yet another government bank. Actually, we want to get rid of all government banks, except for one, which is not a bank in the normal sense. It's a tier 2 institution that only facilitates and leverages the then privatized banking sector. Right. So the number of state banks, all of us don't want to grow, not at all, just to contrary. Okay, so I don't see any other hand and no new comment coming in. If I'm not overlooking something, let me just go to the end of the line, but I don't think we are. And so for that, I would say we conclude our session well in time. I want to thank all participants, all co-authors, all authors, all discussants for their input, and it's greatly appreciated. And we hope that we have an opportunity to continue our discussion with all of you individually and institutionally in the future, because one purpose of all this effort that we made is to basically inject some ideas in a process that we know goes more or less in that same direction, but may benefit from a, let's say, unified view, a system-wide approach, so to speak, in this discussion. And that's what we wanted to deliver. So thank you for your patience, for your attendance, and I wish you all a good night.
Thank you.
Thank you. Thank you.
Thank you.